Did you know that your retirement account right now, today, might be sitting on the capital you need to invest in commercial real estate? I'm not talking about cashing it out. I'm not talking about paying penalties. I'm talking about completely legal IRS approved structure that most financial advisors have never even mentioned to their clients. Here's my question to you. If you had access to say 50,000, 100,000 or even 200,000 in tax sheltered capital and you could put it to work in a physical income producing asset instead of watching it ride the stock market or get beat up by inflation, would you want to know how? Because that's exactly what we're covering today on this video. My name's Jeff Rome. I'm the owner of CAE Real Estate Investments. And in the next several minutes, I'm going to break down the self-directed IRA, what it is, how it works, how to use it to invest in deals like ours and others, and what you absolutely need to watch out for before you touch anything. No hype, no fluff, just structure and math. So let's go. Before we get into the mechanics, here's who we are and why we're qualified to have this conversation. I've spent over 16 years in the healthcare space. In fact, I'm about to open my second molecular diagnostic testing laboratory in Scranton, Pennsylvania. And about 5 years ago, I started spending most of my time investing in commercial real estate. It's really where my passion is. So I'm blessed to be able to have the time to focus on real estate investing. I know what it means to build businesses, manage capital, and create systems. My business partner, Kenton, has over 30 years of direct self-storage operations experience. He has run facilities, managed acquisitions, and understands this asset class at an operational level that most syndicators simply don't have. Together, we focus on self-storage syndications, primarily in the Eastern United States, and we bring in passive LP or limited partner investors who want institutional quality real estate exposure without the headache of active management. That context matters for this video because everything I'm going to teach you today applies directly to how a real estate investor would actually fund a position in a deal like ours. Here's the problem I see over and over again with intelligent, hardworking people who want to invest in real estate. They look at the minimum investment for quality commercial real estate syndication. Let's say it's $50,000, and they think I don't have 50 grand sitting here in a bank account right now, and they stop right there. They assume the conversation's over. But here's the reality. The average American household has the majority of their net worth locked up in retirement accounts, old 401ks, IRAs, pension rollovers, and in home equity. Capital that's technically available, but sitting in structures that most people have never been shown how to redirect. The reason most people don't know about self-directed IRAs isn't because they're complicated. It's because Fidelity, Vanguard, and your typical broker don't offer them because they make their money keeping your money in stocks and mutual bonds. I'm not saying that's wrong. I'm saying it's incomplete. And today we're going to fill in the gap. So let's build the foundation. What exactly is a self-directed IRA? A self-directed IRA, or you might see SDIRA, is a retirement account that operates under the same exact IRS rules as a traditional or Roth IRA. Same tax treatment, same contribution limits, same basic structure. The difference is instead of it being held at a brokerage that limits you to just publicly traded stocks and mutual funds, an SDIRA is held with a specialized custodian, a company whose entire job is to facilitate alternative investments on your behalf. That means your retirement account can own real estate. It can own a limited partnership interest in a private syndication. It can own tax liens, private notes, and physical precious metals. The key principle to understand is this: the IRA is the investor, not you personally. I actually have two investors in my current deal doing exactly this. The account holds the asset, receives the income, and owns the equity position. You are the account holder. That distinction matters enormously And we'll come back to it when we talk about restrictions. Now, you can set up either a traditional SD IRA, where your money goes in pre-tax, grows tax preferred, or a Roth SD IRA, where your money goes in after tax and grows completely tax-free. Both are powerful. Which one makes more sense for you depends on your current income situation, and that's a conversation certainly for you and your CPA. Here's how the process actually works step by step. Let's break it down. Step one, you choose a qualified SD IRA custodian. These are specialized companies, not your typical bank or brokerage. Some of them are well-known names in the space, like Equity Trust Company, I've heard, Directed IRA, Advanta IRA, Madison Trust. So those are some of the names I've heard. Each is going to have their own fee structure and process. So do your own due diligence. And then step number two, you open the SD IRA account and fund it. In most cases, people just fund their SD IRA by rolling over an existing retirement account, an old 401k from a previous employer, a traditional IRA sitting in a brokerage, a 403b. Now, when done correctly as a direct rollover, this is a tax-free event. You're not cashing out. You're moving basically the vehicle, not the money. Step three, you direct your custodian to make the investment on behalf of the IRA, right? So you identify the deal. Let's say it's a CAE self-storage syndication. You complete the subscription documents showing the SD IRA as the investing entity. And then you instruct the custodian to wire the funds. That's it. The custodian executes on your direction. In step four, all of the income from the investment follows back into the SD IRA. Preferred return distributions, equity at exit, or refinance, every dollar goes back into that account, sheltered from taxes. Think about what that means. So if a deal generates an 8% preferred return on a $100,000 SD IRA investment, that's $8,000 a year compounding inside a tax-sheltered account, not getting haircut by capital gains taxes every single year. The compounding effect of tax-sheltered growth in a real estate asset is one of the most powerful wealth-building mechanisms available to individual investors. And it's available to you. And most people have no idea it exists. Let me take 60 seconds and really drive home why the tax structure here is so significant. So in a standard taxable brokerage account, every time your investment generates income, distributions, interest, capital gains, that income is taxed in the year that it was received. You're constantly paying the government out of your returns before they compound. In a traditional SD IRA, that income is deferred. It compounds without being taxed each year. You eventually pay taxes when you take distributions in retirement, but the compounding you've done in the meantime is substantially greater. And in a Roth SD IRA, you pay taxes on that money before it goes in, but after that, it's done. Every dollar of return, every distribution, every equity gain at exit or at a refinance is tax-free permanently. Picture this. All right, so you roll $150,000 from an old 401k into a Roth SD IRA. You invest it in a CAE self-storage deal. Over a 5-year hold, that $150,000, let's say it generates $60,000 in preferred return distributions plus distributions of $90,000. Let's say there was a refinance or an equity at sale, so another $90,000 in equity. That's $300,000 out. And in a Roth structure, every dollar of that growth is yours tax-free. That's not a tax strategy. That is a wealth strategy. Now, and I want you to pay really close attention to this section because this is where people get into trouble. The IRS has very specific rules about what you can and cannot do with an SD IRA. These are called prohibited transaction rules, and violating them can cause your entire IRA to be disqualified, meaning all of the tax benefits are immediately unwound and the entire account balance becomes taxable. That's a catastrophic outcome. So here are 3 things you need to understand. Okay, rule 1, The IRA is the investor, not you. You cannot personally benefit from any property owned by that SDIRA. So if the IRA owns a rental property, you cannot live in it, you can't vacation in it, you can't use it in any way. All right. Rule 2, disqualified persons. You cannot do business with yourself, your spouse, your parents, your children, or their spouses through the self-directed IRA. These are called disqualified persons, and transactions with them would and are strictly prohibited. And rule number 3, unrelated business income tax, or UBIT. If your self-directed IRA invests in a deal that uses, say, debt financing, leverage, a portion of the income generated by that leverage may be subject to a tax called UBIT, even inside the IRA. So this is a nuanced issue, and it's critical to understand in the context of specific deals. And here's the good news for passive limited partner investors in syndications like CAE. When you're investing as a limited partner, not operating the property, not managing the property, not signing on debt personally, the prohibited transaction analysis is significantly cleaner. But you still need to work with a qualified CPA who understands self-directed IRAs before you take and make any move. I'm certainly not a tax advisor, and nothing in this video is tax or legal advice. I'm just giving you the framework. It's your job to bring it to the right professionals and have that conversation. We'll help you do that. So let me put this all together and show you what it looks like applied to an actual deal. So CA Real Estate Investments acquires, repositions, and operates self-storage facilities through a private syndication structure, right? So as a limited partner, you invest capital, your self-directed IRA's capital, and receive, say, an 8% annual preferred return on that investment before our team participates in any profits. Okay, so that's a standard preferred return. When the asset's sold or refinanced, LP investors participate in the equity distribution based on their contribution, obviously. You do none of the work. Myself, my partner Kenton, we run the operations. You own the position. The self-directed IRA investor who rolls that $100,000 into the deal structure receives, again, 8% per year in preferred distributions, flowing directly back to that IRA. And keep in mind that preferred payment may not start the first year, but it'll occur and you'll eventually get it. But that's tax deferred, or in a Roth, tax free. And when we exit the deal, they receive their principal back plus their share of appreciation. This is why sophisticated investors use self-directed IRAs to invest in syndications. It's not a workaround. It's the structure working exactly as designed. All right. If you made it to this point, you may be serious, and serious investors deserve real resources. So here are 3 things I want you to do right now. Number 1, subscribe and hit the like button. We have 2 more videos coming out in this series, solo 401k and HELOC strategy. You're not going to want to miss those either. Each one builds on the last. All right. Number 2, comment the word playbook below, or just grab the link in the description and I'll send you the full CRE Capital Playbook. It's a PDF I put together that covers all 3 vehicles in institutional detail: contribution limits, tax treatment, side-by-side comparison, and a decision framework to figure out which one may work best for your situation. It's free, it's yours. And number 3, if you're actively looking at investing in commercial real estate, if you have an old 401k or IRA that you've been wondering what to do with, book a 30-minute call with me. The link is in the description. Just follow the link and join our investor list. No pressure, no pitch. We'll talk through your situation and tell you whether we think we're a fit. That's it for today. Next video, the solo 401k. And if you're self-employed, even part-time, you're going to want to see what's possible with this crazy vehicle. It's arguably the most powerful retirement account available in the market today. I'm Jeff Roma, and this is CAE Real Estate Investments. No hype, no fluff, just structure and math.